Time for the Word on Wall Street, where we discuss what's driving markets and the economy. Joining me this morning, Bull Tick Capital Markets Head of Global Research, Catherine Rooney-Vera, Skybridge Capital Co-Chief Investment Officer, Troy Gajewski, and Portfolio Wealth Advisors President and Chief Investment Officer, Lee Munson. First up, futures are pointing to gains this morning to start U.S. trading. Investors bracing for a huge week of earnings and economic data. Meantime, gold prices soaring to a new all-time high this morning, close to $2,000 an ounce. Catherine, let's kick it off with you. What is most important this week?
The most important thing is and will continue to be stimulus, both from the Federal Reserve and from the U.S. government. We are expecting some additional stimulus to come from both entities and to be announced in the very near term. This is what I think has driven the markets up 45% from the lows, and what is the only thing, in my view, that can continue to move markets higher.
Let's move on. What about the earnings season, Catherine? Before we move on, you have a dozen Dow components reporting: Facebook, Apple, Amazon, Alphabet, all out this week. What are you watching on that note?
I'm looking to see if earnings corroborate the numerator in the PE multiple, which is, of course, price to earnings. Prices have soared, earnings have not kept pace, but the market has wholly discounted some improvement on earnings, maybe even beating expectations, which are already dire. So if we beat the baseline, which is very negative, Dagen, then I think that you're going to see a market that breathes a sigh of relief.
Moving on, I want to get Lee in here on these earnings. So only about a quarter of the S&P have reported second quarter earnings so far, 80% beating earnings estimates. Per share earnings are down in the S&P 500, almost 37% from a year ago. That's just really astonishing come down, particularly for a market that's just kept on chugging. Lee?
There's nothing great about earnings. What I find hilarious is I was reading some notes from everywhere from Bernstein to Goldman Sachs on Apple earnings, and everybody says the same thing. We're expecting a miss or lower earnings this quarter. We're expecting, earnings direction going down, going through the end of the year, and that's the case for both bulls and bears. So I think from a perspective of earnings, we know they're weak. We know the analysts have brought all the expectations down. So the real issue this week is going to be the congressional committee hearings on, Facebook and Apple and Google. Yep. And remember, one of the main things that happened back in .com was when Microsoft hit their regulatory wall, and that was one of the things that topped that market. I'm looking this week to the market's reaction more to those congressional hearings and less to earnings, because again, bulls and bears, 100 points on a stock difference in their opinion, are coming up with the very same things to look out for. The only difference are these congressional hearings. I think those are key to earnings. I think that's what's going to bring this whole week together.
Let's talk about coronavirus cases. Troy, I have not gotten to you on this. I would push back on what Lee is saying, that somehow those hearings are going to matter more than rising virus cases. I think there's a possibility that even Texas is going to have to shut down again. You see, and it's not just red states, it's Florida and Texas and then California. How does that factor into the picture this week? Troy? I don't know.
Yeah, Dagen, I mean, that was a good point you just made in parallel to the previous .com bubble. However, yes, Dagen?
Troy, can you hear me?
Okay. Yeah, I can hear you fine.
Okay, what about coronavirus cases? How is that? How is it the market, for the most part, other than last week, is ignoring the fact that this virus is growing and spreading still?
Yeah, so look, again, as your earlier guest said, the main driver of market recovery has been a spectacular fiscal stimulus, but more importantly, the stimulus that's come out of the Fed. And so, even the upcoming election, which would have been the most important driver of markets, if not for the pandemic, takes a back seat to the fact that we're about to get at least $1 trillion, probably closer to $2 trillion of fiscal stimulus, which will help bridge this gap in the economy. Remember, $1 billion I mean, it's not 3.2, but that's still almost 5% of GDP pre-COVID and roughly 5% of GDP today. So even $1 trillion would be very muscular. Interestingly enough, the Fed balance sheet has stopped expanding here the past 5 weeks. So we expect further expansion there as well. Those are the only two factors we think that can drive markets higher at these elevated multiples right now. And if we don't end up with a Fed that continues to step in and increase their balance sheet, we think we're in for more long consolidation range after a spectacular balance sheet bottom. So in the near term, fiscal stimulus, monetary policy, as typical, will be driving the economy. If we do get another shutdown of key states, that's obviously going to be a hurdle that's going to be very to overcome, although we don't expect that right now, right? The government's sort of made the cost-benefit analysis that we just can't afford to have formal shutdowns anymore like we did earlier in the year to help flatten the curve case. So we think markets are more range-bound here with more volatility.
Thank you all, one and all. Catherine Rini-Vera, great to see you as always. Troy Gajewski and Lee Munson.